Hello and welcome to our review of the third quarter of 2016. My name is Ken McNeil, Director of Wealth Management and Portfolio Manager at Richardson GMP. In this review, we're going to look at the performance of the model portfolio, which is very similar to everybody's return. We're going to look at the backdrop to the stock market outlook, where we are right now, where we're going. We'll look at the individual picks that we've made and why we're doing them, why we're owning these particular things. And finally, we'll look at the portfolio weightings in the various industries and why we're doing that. So this should give you a good idea of what's happening. Now, if people want a more in-depth review, that's certainly available. Just ask. So here we go. This is the model portfolio, and the performance has been really excellent. I just feel so good about this, and I hope you do as well. In the third quarter of this year, we just came through, we're up a little over 5%, more or less the same as the Canadian stock market. Over here we have the growth blend. Now the growth blend is a combination of the Toronto stock market rate of return, 70%, and 30% in the bond market index. So a 70-30 split, which people think is where a growth investor should have their weightings between stocks and bonds. Now we don't do a fixed weighting. With me, if things are safer than normal for the stock market, we'll own more than 70%. If it's more dangerous than normal, we'll own less. And this is how my clients avoided the crashes in 2008 and back in 2001 too. So, but it's a thing we'll be aiming for performance on the long run, 70-30. Now, year to date, once again, we're just a little bit better than the Canadian stock market. And I must say that the Canadian stock market has been one of the best developed stock markets in the world, or it is the best developed stock market in the world. So keeping up to the best market in the world is quite an accomplishment, actually. But where we really shut the lights out is on a year-over-year basis, we're up almost 24%. So that's from September of last year to September of this year. Now, how we got this incredible performance is very interesting. The year-over-year performance of the Canadian stock market is around 13%. The U.S. stock market has only done a little bit better than 1% better. So 13% here. The U.S. stock market year-over-year in Canadian dollars is up about 14%. But they got to that performance very differently. The Canadian stock market, as you see, so far this year is up about 15%. So in the last quarter of last year, it was down. So down 2 or 3% here and up about 15% here equals this rate of return. The U.S. stock market was different. This year, it's only up about 5 or 6% in Canadian dollar terms. So to get to 14%, it was up 8 or 9% back here in the final quarter of last year. So up 8% here and up another 7% here equals 15%. So what we did was we owned the U.S. stock market almost exclusively back here, avoided the Canadian downswing. We swapped into the Canadian stock market in January very heavily, and we took advantage of the best stock market here, which is Canada. So we went from the best stock market in the world, which was U.S. here, to the best stock market in the world, which is Canada here. And getting the best of both worlds, we did tremendously better than both markets. So I feel very good about that, and hopefully we can do that in the future. So let's take a look at the future here and where the stock market is right now. Now every quarter I talk about the same things because I want to look at the big picture. as to how much we should have in the stock market. Should we have more or less? Is the stock market more risky than normal or safer than normal? And to determine that, we have these three things, which are valuation. Is the stock market cheap or expensive? We've got sentiment. Is the general public pessimistic or optimistic? And the outlook, the economic outlook. In particular, are we heading towards a recession? Recessions are money killers. That's where stock markets go down 40, 50% as they did in 2008. So we want to avoid recessions. So looking at this at the moment, I'd say that the stock market is cheap. Why? Well, it's because dividend yield of the stock market is extremely rich. The Canadian stock market yields 2.8%. That's up from 15 years ago where the yield was about 1%. So we've gone almost tripling the yield. The average over the last 15 years is 2.5%. So we're talking much higher than the average yield. And also during that same time, bond yields have dropped unbelievably. The Canadian government 10-year bond has gone from 6% 15 years ago to 1% today. So we have dividend yields going up, bond yields going down, and now the difference tells me that investors are going to be using stocks for yield, and that will put a tailwind and a lot of buying into the stock market. So I believe stocks are cheap. Sentiment. I believe that I get sentimenttrader.com. I monitor sentiment, and unique things happening in the U.S. and Canada. There's been an enormous pulling out of money by mutual fund investors. That's been happening for the last year and a half. And historically, they've done that when they're very nervous. They're very skeptical of the stock market. So I believe that shows that investors are pessimistic. And when people are pessimistic or panicked, that's a good time to be in the stock market. A dangerous time is when people are optimistic and there's a lot of speculation. So it's much better when things are pessimistic. Now, the economic outlook, I get a service called recessionalert.com, and the outlook for the market, the U.S. economy, is very positive. Leading economic indicators, and their indicators are showing a positive trend for the economy. And also the chances of a recession on their indicator are at the lowest level of their 1 to 5 ranking. It's at the lowest level of 5. And so the chances of a recession are very remote in the foreseeable future. So we have a very positive outlook for the U.S. economy, and we in Canada piggyback on that. So valuation is cheap, that's a check mark. Sentiment is pessimistic, that's a check mark. And the economic outlook is positive, that is a check mark. So that being the case, I'd say that the stock market is safer than normal. And so when we look at investors, a growth investor has a minimum in stocks of 70%, a maximum of 100%, and a balanced investor has a minimum of 30% in stocks, a maximum of 70% in stocks. Well, since we're at the safer than normal backdrop and the big picture, then we should have 100% for a growth investor and about 70% for a balanced objective. The type of things we're looking at to invest in are more yield-orientated areas, high yield things like banks, dividend ETFs, etc. Because I believe that investors will be pushing up those stocks as they buy these areas for the rich yields they get compared to the dismal small yields in bonds. If the markets go up 10 or 20%, we would be shifting to more towards the minimum in the stock market as the stock market got more expensive. And when the markets go up 20%, you can bet that people are going to be much more optimistic. So that's when we get into the more dangerous markets. So that is how we structure the portfolio. Now, if we say we're going to be 100% in the market for a growth objective, what do we own? Well, let me show you how we make these choices. We are momentum investors. We buy things that are outperforming the market. We avoid things that are underperforming the market. And in doing this, you've seen over the last few years that we avoided the energy market in Canada. It was crashing in 2015. We were out of the Canadian market when it was having a bad time last year, etc. So this is one of the leading reasons why our performance has been so good. So the first consideration on investing is how much should we have in Canada or the US? And right now, I'm pretty neutral on the Canadian dollar versus US. As you remember, back in January, we made a big switch into the Canadian market when the currency was at its absolute low, and that gave us a huge boost. Last year, we were in US things when the Canadian dollar was falling, and owning US gave us a big boost. So currency is a big thing, and I've shown some good judgment as to when to own one or the other. But at the moment, I'm sort of neutral, slightly short-term negative on the Canadian dollar, but over the next 6 months to a year, I think that the Canadian dollar could do very well. So that's number one consideration. Now, from there, we look at if we're in the markets, the Canadian market ETF, the TSE ETF, or the Canadian dividend ETF is where we'll be owning in Canada. In the US, we're looking at the general stock market ETF or the general dividend ETF. So those are the two, these are the go-to areas in each market. So if we can't find an industry ETF or a stock to own that we think is going to outperform the market, we simply own the market, or we own the dividend stocks in that market if the dividend stocks are doing better than the general market. So that is the go-to area. Now, occasionally we're going to find individual industry groups that are outperforming for a good reason, and we'll own those. At the moment, we own bank ETFs and bank stocks, utilities, and energy. So those are things we're concentrating in Canada. In the US, we're looking at technology and internet area. So when we own these, let's say in future we decide that a certain group is no longer outperforming and we want to shift, quite often we'll be buying back one of the dividend or TSE. We don't keep cash. I mean, a lot of advisors out there, when they sell something, they keep cash. We don't do that. If we say we're going to be 70% in the market or 100% in the market, we stay invested by using the general market or general dividend market ETFs. And that keeps us up to our weighting in the markets. So these are the things we're owning right now outside of the general market ETFs. On the watch list in North America, we've got gold mining. We might own that at some point in the future. Consumer in the US, we did extraordinarily well last year on those areas, but since mid-year they've been underperforming. We don't own them, but I think that at some point in the future they might start outperforming again, so they're on the watch list. Now over here on the international area, Europe is still underperforming. Emerging markets are doing better than the US market, but not as well as Canada, with the exception of South America. South America, we have an ETF there that owns the stocks in the whole continent, Argentina, Brazil, Colombia, Peru, Mexico, Chile, etc. And it's solidly outperforming both Canada and the U.S. markets. On the watch list, we have India, which has new reformed laws, which could make it a real standout performer in the future. Infrastructure ETF is looking interesting. If countries start spending to create jobs by doing infrastructure, in particular the water infrastructure, there's actually an ETF that invests in water utilities and the people that build them. China Internet is an area that could be a huge winner as well. So these are the things in the international area that are on the watch list that you might see in a portfolio in the foreseeable future. So when we're looking for things that are outperforming, I just wanted to show you one chart of how I do that. You know, I construct these charts and monitor them very regularly. This is the TSE Bank Index ETF. And last year we didn't own the banks because they were underperforming. This year we have a very large holding. And so I construct a chart, and for here, from the January 20th low, I watch them going forward and the percentage rate of return. The black line here on the bottom chart is the bank ETF. And we can see that it's doing a little bit better than the Canadian stock market ETF, which is in green, and very much better than the U.S. market, which is red. This is the Canadian dollar valuation of the return on the U.S. market. So what we see here is from the last low in the market, January 20th, that the banks are outperforming. That's what we like to see. That's the kind of investment we're making. And the chart above here is just a longer term performance, and the bank ETF is also outperforming on the longer term. So, and they have dividend yields of about 4% in a world where bond yields are microscopic. So I think there's a real tailwind for this area as well. So I do these types of charts on all the various indexes, the sub-indexes, etc., and countries and so on and so forth. And then I also do that on individual stocks as well to see whether stocks, you know, is Royal Bank outperforming the bank ETF, and it might own an individual bank if it does better than its own index. Here's the weightings of the model portfolio at the moment. Once again, this is not exactly what every client would have, but it's a good indication. Cecilia keeps things very close to the model portfolio. First of all, as far as the currency exposure, right now we're 63% Canada, 32% US, and we do have that 5% in South America. So back at the beginning of the year, we were almost exclusively in the US when the US dollar was doing great. And this year, Canada's done super, and we're weighted in that area. So that was a good move. So up above here, we have the weightings in the Canadian market and the US market, as well as our portfolio. So the model portfolio. This is a hypothetical $1 million portfolio. And this line here is the TSE weightings in these various industry groups. Now the way you get performance or avoid bad performance is to be in the right industry groups at the right time. Avoid the ones that are doing poorly, be in more of the ones that are doing well. So the TSE index is quite a bit different than the US, and this is the US index down here. So let's take a look at where we're high in relation to these various indexes. We're 21% in financials, which is basically banks, which is quite a bit higher than the US market, where they have 12% in their index, but less than Canada, which is very heavily weighted towards the banks. On energy, we have about the same weighting as the Canadian market. which is quite a bit higher than the U.S. market. Now, compared to the U.S. market, we're low in consumer here, but where we're really high is in utilities and telecom. These are the high dividend areas. Compared to Canada, we're very high in information technology, and but less than the U.S. U.S. is very high in technology. So this is where we're high in the high dividend paying areas. We're above the market weight in Canada on energy, and we have quite a bit of banks. So I think this is a good mix going forward for the type of markets I see over the next period of time, which I think will be focused in on people buying high-yielding stocks because bonds just provide such a low rate of interest. So that's it for the review. Like I say, if you wish to have a much more in-depth review looking at all the indicators in depth, all the individual ETF holdings in depth, that's certainly available. Just ask and we can do that. And so that's the quarter, and if you have any questions, please call me. I love chatting about this, and you have a great day.